Hey everybody, this is Kenneth Hamilton with Mission Financial Planners. Wanted to thank everybody for taking some time to meet with us today. We're doing a crash course on the market, what's going on, and what to do in the future. We are honored to host Ms. Kara Murphy, who's a CFA and the Chief Investment Officer of Kestra Investment Management. She has extensive experience in investment strategy and portfolio management. Kara, she brings valuable insights into market dynamics, economic trends, and the impact of policy changes on financial markets. As CIO, she leads Kestra Investment Management's research and investment strategy, providing critical market commentary and guidance for financial professionals. Today, we're going to dive into key topics, including the latest tariff policies, market volatility, interest rate movements, and economic growth policies and prospects. So, Ms. Kara, why don't you kick us off?
Well, thanks so much for having me. And, I'll just share that people are always more interested in talking to me when things are going a little kablooey. That's what it feels like right now.
Yeah.
But, so these are interesting times, right? So we have lots and lots to talk about. What I will say is there are a lot of headlines going along that are, seem very, very impactful. And they are impactful in terms of like the, policies that are being implemented. But then you have to sort of juxtapose that with like, what's the underlying health of the economy and the market? And that's really our job, right? To distill down what we need to be paying attention to and what maybe we don't need to pay attention to so much.
Fantastic. Kara, I've got a question for you. So we're thinking about, just what you said, right? The underlying economy is strong. Inflation has been super pesky. Like it's gone down way slower than anybody hoped it would. The Fed has held firm on interest rates for a while now. Now we have tariffs in the mix. How does, Fed policy, high interest rates, inflation, tariffs, how do you see all that fitting in? How do you see all that affecting the economy?
So let's start with tariffs, because I think that's the area where I get the most questions. And honestly, until a few years ago, tariffs wasn't really an accepted policy tool. So we never really talked about it. So we, a few years ago when tariffs kind of got pulled out of the policy bag, if you will, we started doing some more research to really understand how have tariffs been used in the past and what's been the impact. So if you don't mind, and you guys know me, I love charts. Mm-hmm. So if it's okay, I'll share my screen. Because I think pictures are always really helpful in understanding and putting some perspective on things.
Okay.
So let's see if I can do this properly. Okay. So this is looking at tariffs that are collected relative to all imports going back to 1900. And if you look, in periods of the early 1900s, nearly 30% tariffs on all imports. That's a really extraordinarily high level. Now, remember at that time period that the amount of goods that Americans bought that came from overseas were a relatively small portion of what we did, right? Like most things were produced in the town that you lived in. But you'll see here, like during the 1920s and 30s, there was a reacceleration in tariffs, but then post Great Depression, there has essentially been a downward trajectory in tariffs since that time. This reacceleration of tariffs during the Great Depression were blamed for worsening the depression, and that's why there was broad policy agreement that tariffs are bad. You see there we have things like NAFTA, the WTO. These were all really broad agreements with our trading partners with the goal of increasing trade. And with that, consumer prices came down, right? Because we had a lot of cheap goods from China that were being imported. And you also had in general global trade that was increasing. Now, if we look all the way to the right, you see the tariffs that were introduced during Trump's first administration. And you see we have a small sort of like jump up from near zero tariffs to about 3%. Now we have a whole new round of tariffs that have been, and I'll note that level stayed consistent through the Biden administration. So Biden made a few adjustments to those tariffs as they were initially introduced, but there really wasn't much of a change during that time period. And what that tells me is that both Democrats and Republicans have sort of accepted tariffs as a potential policy tool. Now, there's disagreement about how much and where and why, but I think this is sort of ushering in a new era of where tariffs are used more willingly, not just by the US government, but by other governments as well. And so my expectation was that this will generally increase going forward. How much is the big question, right? And so I said earlier, we need to think about what's important, what we pay attention to, and then what we don't pay attention to. And that's where we're still trying to kind of, identify how large is this issue. One other thing I'll note, and then I promise I'll be quiet because I want to hear what else you guys want to talk about. We do know by looking at the period starting in 2018 when the first round of Trump tariffs were introduced, that there is an impact on prices. So this here looks at the prices for all kind of core goods, and then the prices of just a number of specific products that were impacted by tariffs. And what you see there is like once tariffs get introduced, those products impact by tariffs, the prices go up, and then other prices continue going down. So yes, tariffs did impact prices for those particular products, but I will note that unless you were like very focused on one of those particular products, you probably didn't feel it, right? Because other prices were coming down. And so this is the magnitude issue. How many things that most Americans buy are going to be impacted by these tariffs? We just don't know quite yet.
So is it kind of like if gas is cheap, I'm not really worried about buying a foreign car?
Yeah, absolutely. Right. Because it's all an offset.
Right.
Eggs are higher, but there are a lot of other foodstuffs that we buy regularly that are down. Now our eye catches the eggs, but when we check out, the overall number that we're spending may not actually be all that different.
Sure. Well, thank you for that. I know Jason has some questions about economic growth that he's hearing from his clients.
Yeah, definitely. Kara, I was wondering how you and your team are seeing economic growth going forward with all these moving pieces that are in play right now.
Yeah, and this is always a very complicated question to answer because, we live in a very large, very diversified, very complex economy. So we try to sort of distill it down to a couple of different pieces that we focus on. So if you don't mind, I'll go back to my trusty charts and show you a quick picture there. So let's pull this up. So this is one series that we spend a lot of time looking at it. I like it because it comes out very quickly. So we generally have this data within like 2 weeks of the end of the month, whereas a lot of other data we might have to have months before we actually get it, and then it gets revised a lot afterwards. So this is ISM Manufacturing is the blue line, ISM Services is the gold line. What these surveys do is they call people from these companies and they say, is business better or worse than last month? And they have a series of questions that they ask, but they're pretty straightforward and they're pretty quick. And what we do is we look at how they change from month to month. So what we see here is that gold line, those are services. Remember, about 2/3 of the economy is focused on services. Think things like your haircut, your accountant, your tailor, things that have a person attached to it. That gold line you can see peaked in 2022, came down quite significantly, but always stayed above 50, which means that services were continuing to expand. That blue line is manufacturing. You can see there a similar peak in 2022, 21-22, rapid decline, but stayed below 50, meaning in contraction for a full 2 years. What we're seeing now, interestingly, is that manufacturing is starting to come up and then services is starting to come down a little bit. So where we're seeing the strength in the economy is shifting a little bit from services to manufacturing. But overall, it looks like both are in expansion territory. So again, we have a lot of different sort of measures of this, and we're going to see more volatility about it simply because, one other data point that I'll mention is that we saw imports spike over the last month. Think about why imports might be spiking. Right? We have tariffs that are threatened. We think our prices are going to be higher going forward. So we're going to rush to buy things. My son just got his driver's license. We knew
Oh
that we
no.
were going to have to. I know it's scary, right? It's scary.
I'm staying out of Austin.
Right? It's a good idea. It's a good idea. I'll let you know when it's safe to come
Okay.
back.
Okay.
But like we knew that we were going to have to get another car for the family. So I was like, we better do this now, right? Otherwise it might be higher prices going forward. So a lot of families across America are making similar choices. So we've pulled forward some buying that's created some volatility, but doesn't necessarily sort of tell us that the economy is slowing. It's just that it is creating a little bit of noise in the numbers.
Hey everyone, it's Matt Donaghue. If you want to see how this video really applies to you and your personal situation, get a hold of us. You can always call us at 888-339-0093. Once again, 888-339-0093. You can email us at admin@mfplanners.com. Once again, that's admin@mfplanners.com. Otherwise, go to our website, www.missionfinancialplanners.com. Once again, www.missionfinancialplanners.com, and just click on the About Us tab, and you'll be able to schedule one-on-one time with either me, Kenneth Hamilton, or Jason Duffaut. We're all certified financial planners. We're all standing by, ready to help.
That makes sense. I know Ken has some questions about labor.
Yeah, and so with some of these economic numbers softening and manufacturing, what impacts is that going to have on the labor market as a whole?
Yeah, this is another area where there's a lot of complexity. So one is that the labor market is another area that can be really hard to get our arms around. So we have a lot of different data measures, and usually we look at a range of those data measures to understand what's happening. And I'll also note that about two thirds of all hiring in the U.S. comes from small businesses, often with like 1 to 10 employees, right? So this is really hard data to be able to capture. So what we do know heading into this year is that labor was beginning to soften. If you don't mind, I'm going to pull up another chart. So we do know that labor has been softening. So this is one measure. It's the measure that's most frequently quoted in the financial press, the unemployment rate. So how many people are looking for work relative to the total labor force? And if you look down towards the right here, you'll see that number starting to creep up a little bit. So labor market is beginning to soften. However, if you look at the absolute rate, so the unemployment rate is a little over 4%, and then you take your eye all the way across back to 1948, what you'll see is that that rate is really low in terms of like the range of normal that we see. So what that means is that it's a little bit harder to find a job today than it was a year or two ago, but there's still a lot of jobs available. Now, the other piece of noise that I'll add to that is DOGE, right? So we're seeing a lot of layoffs within the government. The government employs a lot of people. So we're starting to see layoff announcements, and we just had that this morning, where layoff announcements ratcheted up significantly. Now, again, like this won't continue forever, right? Because there are only so many federal employees available, but it is introducing some noise into the economy. And certainly communities that have a lot of those workers are going to be impacted by those layoffs. But it's that in particular is a policy decision and not a reflection of what like American businesses are deciding to do. And that ultimately is going to decide the direction of the economy.
Okay. And again, the government, do we have any idea of roughly how many the government employees federally?
So we do. So the government has really, really good data. And if you can, you can go through a lot of these roles, you can see not only how many people are employed, but by what agency. And so you can get a fair amount of data there. What I thought was interesting, I mapped this out recently. You can look at the number of federal employees relative to the size of the labor force going back many decades. And what I found really interesting is that beginning from 1950 to now, the relative size of the federal workforce has gone down dramatically relative to the size of the labor force. So again, what this means is that as we see, more government employees being laid off, and not to say that this isn't hard for those people who are impacted by it, but relative to the size of the overall labor force, it's a much smaller piece than what it might have been in the 1950s.
Okay. Okay. So again, it's going to impact people, but in regards to the broad global or the U.S. economy as a whole, it's not going to move it too much.
Yeah, the impact is limited.
Okay, great. Matt, what are some of the questions you're seeing?
I'm getting a lot of questions. It's like when we were getting ready for the call, we talked about this a little bit. It's kind of like 2022 all over again in terms of some of the conversations. But we're also having a lot of questions about gold. And for those of you watching, we did our weekly market update on Monday where we talked a little bit about gold. But Carol, what's your perspective? Where are valuations at? What kind of market pullbacks do we see, year in and year out, not just in a down market year? And then what on earth is going on with gold?
Yeah, those are big questions.
Yeah.
So let's start with valuations because,
Okay.
I've been in this business 25 years, and this is always something that we focus an awful lot on. So this in particular is looking at the price of the S&P 500 relative to what those companies are expected to earn over the next 12 months. And starting with 2000, you'll see that currently we're running at about 22 times. If we compare that to that historical period, so about 25 years, we're at the high end of that range. Okay, so what does that mean? That means that we're paying a lot. As investors, we're paying a lot for the earnings that we're expecting over the next 12 months. The average PE, or price to forward earnings over that time period, is about 16 and a half times, right? And you can just tell visually. That means that valuations are fairly high. But I know I've talked with you guys a lot about the Magnificent Seven, right? That's gotten a lot of focus over the last couple of years. Those are 7 of the largest companies in the U.S., and they also tend to be the best performers over the last couple of years. Those particular names have much higher valuations than the rest of the market. And because they're so big, they have an outsized impact on the S&P overall. So although we see, higher valuations for the S&P 500 overall, a good portion of that is being driven by those handful of names. And if we step outside of that, valuations look much more reasonable elsewhere. I will also note that I always say valuation is a terrible timing tool. So just because valuations are high doesn't mean that they won't stay there for a good long time. So it adds, something that we want to pay attention to in the market and we want to think about, but not necessarily telling us that, it's time to sort of beware. So something that we spend a lot of time thinking about. You mentioned gold, and I find this really, really interesting. Gold comes in and out of favor during different periods. Like, we have a view that gold is not what we would call a strategic asset class. So we don't think it's something that you should just have in your portfolio and leave there forever. And partly, and I'll share another chart on this in a moment, is because it doesn't have a great track record of growing wealth over time. And when we look at the performance of gold over the last couple of years, it's been largely driven by central bank purchases. So that's what we're looking at here. So over the last 10 years, what have central banks done in the gold market? And you'll see those dark bars are through the first half of the year. The gold bars are the second half of the year. In 2024, we have data for the first half of the year. So that's why we separate those two out. And what this tells us is that in 2024, gold buying by central banks actually accelerated relative to what we've seen in the last couple of years. So why are central banks doing this? And by the way, it's not the Fed, the European Central Bank, and like the Bank of Japan, right? It's not the largest central banks in the world. It's smaller central banks who are looking to diversify their holdings. So many of them have very large positions in things like dollar, yen, euro. And so they're looking for something else to be able to have as a store of value. That, in my mind, won't continue forever. There's only so much that these central banks can really load up on gold. But the other thing that I'll mention in terms of the attractiveness of gold is more psychological. And so I always like to share the example of my father-in-law, who grew up in East Germany, was there during World War II, escaped in the dark of night in the back of a farmer's carriage, to get over to the West. He lived through really, really traumatic times. He, you know, eventually moved to Brazil and then up to the United States. But he carried with him that experience. And because of that, he really wanted some gold coins in his safe in the basement. And when every one of my kids was born, he presented us 2 gold coins for that kid. And then he took them back and he put them in the safe. And that's where they all are today. And that helped him sleep well at night, right? And I totally understand why that's the case. But from the time that my kids met, my first kid is 16 years old now, from the time that he was born, we've actually done better in our stock investments than we have in those gold coins. But those helped him, right? And I totally understand. But as we think about growing wealth reliably over time, I would hesitate to put, you know, a lot of somebody's wealth into this because it just hasn't been able to grow in the same way that we've seen stocks have been able to grow.
So, to recap, where does your father-in-law live? No, I'm kidding. What I took out of that was banks are diversified. You should be diversified. And if you're working, you know, and everyone who's listening to this is working with Ken, Jason, or I, you need to be looking at how we diversify the portfolios through our partnership with Kestra Investment Management, because we've got factor tilt, we have active equity, we have a lot of different things we can do in addition to liquid alternatives that can really pull down your
volatility.
Thank you, volatility. And guess what? That means that even if the market does pull back, you're not pulling back as hard as the rest of the market is. So,
and you know, Matt, if I may jump in on that point, like the experience in the market so far this year is such a great reminder about why we own different types of asset classes.
Exactly.
So I ran these numbers like a day or two ago, so they're a little bit out of date. But if you look at NASDAQ is down 6% ish so far year to date. S&P is down about 2%. The ag is up about 3%. So fixed income markets in general are up about 3%. And AIFA, which is non-US developed markets, is up 9%, right? So these are asset classes that, you know, like didn't do so well last year, but then here we are first couple months of the year, and they're actually providing that diversification and that smoother ride for portfolios.
Yeah. Well, that leads into, I know Jason has a question about downturns and staying invested for the long run. So Jason, go ahead.
Yeah, definitely. You know, a lot of the client concerns that come to us is, you know, when we think a market is getting dicey, either because of political or tariffs or many other things that we run into in that situation, should I just go ahead and exit and just wait for things to cool down to get back in? And how much impact does it make if you do that versus if you don't?
I think this question is so important. And I always say if people like come away with one thing from these types of discussions, it's the importance of sticking around for the long term. And so I'm going to pull up my trusty chart and then we can kind of like talk through why that is. And so the first thing to sort of remember is that stock markets go up and they go down. They go up more often and by greater magnitude than they go down. And that's how we grow wealth over time. So this particular chart is looking at annual returns going back to 1980. Those are the bars. And then those dots are how much the market declined during that year. And so what you'll see is that even in the best years, including last year, the markets were down at some point during that year. And what that means is that you have to ride out those downturns in order to enjoy the upside. And I always say, you know, like people will say like, but, you know, like I'll know when to get back in the market, right? If I sell out now, I'll know when to get back in the market. It's easy to think that you will. But we actually looked at this, and some of the best days in the market are actually after the worst days in the market, like literally the next trading day. Right. And think about, you know, where we were in the end of March 2020. That's recent enough that probably most people listening to this can remember it. I remember that viscerally. Right? The market was down 20% in 3 weeks, the fastest drop that we'd seen since the Great Depression. There were people dying. People were shut up at home. People were losing their jobs overnight, didn't have money to pay for groceries. I mean, talk about a traumatic time. Well, guess what? That was the bottom in the market. we did not get a lot of calls from people saying, I want to buy in now. But people who rode that down and then were there for the bounce as markets went up and markets bounced very quickly, they were able to grow their money reliably during that time period, right? So if you overthink it, there is a very high likelihood that you will miss the good days.
That makes sense. I'm sure there's some statistics.
It's hard to
around that.
do. It's really hard to do. That's why you guys are there, to remind people.
And so I think that's the perfect segue of what's next is let's have a conversation. Matt brought up a very good point. We have a ton of strategies at our fingertips, and yes, there's volatility in the market. We should stay in the market, but it also might mean maybe we should shift, lean into an area that maybe we weren't exposed to before, and let's see what the future is going to hold. And so it all starts with just a quick phone call. Each of you have our numbers, but just in case you don't, it's 726-727-6581 for Matt, 82 for me, Ken, and 83 for Jason. So that's 726-727-6581, 82, 83. I don't know where each of us are on each other's screens, but we're all there. Again, send us an email. If you still can't find our numbers, jump onto our website on the Contact Us page. There's a link for each one of us, schedule a 30-minute chat, and let's see how we can adjust. And we've been working with each of y'all for months, if not years. Your neighbor, your friend might also be scratching at your door, panicking. You can also send them our way. We're happy to talk with anybody that you care about as well. But Kara, your time's very valuable, especially with what's going on in the world. So thank you for taking this time out for us.
My pleasure.
We truly appreciate it. Matt, Jason, anything else?
Kara, we'll see you April 17th at our client appreciation event.
Can't wait.
Being held at the San Antonio Food Bank. So anyone in Central or South Texas who's watching this, make sure you're there. Circle the date on your calendar, April 17. You're going to get to see a knockout presentation that includes country music, and that's all we will say.
Love it. Love it.
We
So
got
excited.
a chance to preview it a few weeks ago, and it's fantastic. But Kara, thank you so much for
All
your
right.
time.
Take care, guys.
Thank you, Kara.
Hey everyone, it's Matt Donaghue with Mission Financial Planners. I hope you're enjoying this video. Make sure you like and subscribe and share our YouTube channel with your friends and family. There's a lot of great information here that a lot of people need to know. So don't forget, like and subscribe, and feel free to reach out to us if you have any questions.